Hello, Maverick Traders. Welcome back. Corey Halliday here with you. And today we're going to dive into the futures market and explore contango versus backwardation. These are pricing structures basically where you can compare the front months to the back months. There's normal, there's abnormal, and if there's something out of the ordinary, we want to ask ourselves why. What is causing this? What is the factor that's driving this supply and demand in equilibrium, abnormality, and it can give us a bit of information as to where that commodity is going. And if I'm trading the energy markets, the energy sector, I want to know what oil's doing. I want to know whether oil's in contango or backwardation and what that suggests for the future. So there's some excellent information here that should be understood and be a guide towards future positioning in these markets. I hope you enjoy it. Let's get to it. So let's talk a little bit about the futures market. Now, the futures market, you can tell by the name itself, it's talking about something in the future, right? Basically a contract that creates a promise to buy and sell at a future date. And that's where the name comes from. Futures are, there's a lot of different futures, but for the most part, they're kind of focused on commodities. Now, there can be some financial futures. You can trade futures on, bond yields and all these different components. There's even S&P futures. There's NASDAQ futures. But when most people think of the futures markets, they think of delivery of commodities. There's lumber futures. There's oil futures. There's nat gas futures and so forth. And so how do futures differ from options is important to understand. So in the options market, you have a promise and a choice. So options, as the name suggests, gives someone the ability to do something, but they can also walk away. They have the option, right? And so the buyer has an option. If you buy a call, you have the option whether you want to exercise your call to buy the stock. But if you decide you don't want to exercise that, you get to walk away from it. Now the call will expire and you'll lose what you paid for it, but you have the choice. Another word for option is choice. You can exercise your right or you can walk away from the deal. The seller of an option does not have an option. He makes a promise. He has an obligation. He has to fulfill his end of the bargain if the buyer of the option exercises their right, right? So if I go out and sell a call or sell a put, I'm making a promise and I have to make good on that promise. Now, when I sell an option, I get paid a premium. I'm not going to promise to do something without a payment, right? But I'm promising, and so I am locked in. Now in the futures market, it's different. In the futures market, the buyer makes a promise to buy, and the seller makes a promise to sell. In the futures market, as compared to the options market, it's two promises. The buyer doesn't have the ability to walk away from the deal. They can't just say, oh, never mind, whoops, I made a mistake. No, they made a promise to buy. The only way they can walk away from the deal is they have to buy their way out of it. They'd have to pay the existing price. In the futures market, there is not different strike prices. It's just a promise to buy or sell at a future date, and your prices are locked in the moment the trade takes place. So let's kind of compare here for a moment. If we think about options, you would choose a date out in the future, let's say October, and there would be a strike price, right? And you could choose a call or a put. Calls over here, puts over here. And let's say that, the stock or whatever is trading around $50 per share. Well, there would be a $50 strike price. And so let's use the call option, and let's say that the call option's trading for $3. That's its premium. So there's a premium payment. That's not happening in the futures, but there's a premium payment over here. The call buyer pays $3 or $300 because it's times 100, right? One call contract controls 100 shares of the stock. So the option buyer pays 300. The option seller collects 300. There's a premium payment when the transaction goes through. Now, fast forward to expiration. This call buyer can either exercise his right to be able to buy the stock at 50, or he can not exercise that right and let it expire. The option seller, well, he either has to exercise his promise and sell the stock, right? This buyer has the right to buy the stock. The seller made a promise to sell the stock at 50. If he comes calling the stock away, I made a promise to sell at 50. I got paid $300 to do it, but I got to sell my stock at 50. I have to fulfill that promise, right? And so there's a transactional price set out in the future, right? The deal is struck. The word strike price comes from we struck a deal at 50 to make this transaction, and there was a payment processed for that, right? A premium that transferred from the buyer to the seller for that amount of time for the ability to buy at 50 or to walk away from the deal. Now, futures are very different in that you will still have a future date. This could be October futures. In this case, there's not a strike price. There's just whatever the October futures are trading for, which can be a little bit different than the September, which can be a little bit different than the November, and so on. But let's say that this is, a barrel of oil. Okay, so this is light sweet crude or something. Oil, October future. Whatever that's going for, let's say that it's going for $92. As soon as the transaction goes through, what happened? This buyer made a promise to buy the oil at 92, and this buyer, or this seller, pardon me, made a promise to sell a barrel of oil at 92. They have both made promises. A transaction went through at 92. There was a buyer and a seller, of course. This transaction obligates this party to buy at 92 and this party to sell at 92. It's two promises. So fast forward to October, you got a couple of choices. Either A, you need to sell this promise to someone else, or B, you're going to be delivered a barrel of oil. Your transactional price already went through. The moment you transacted at 92, that locked you in to pay 92 for the barrel of oil at October time period. And this guy locked in his sell price. Now, let's think about why they wanted to do this. Maybe the buyer of this future is an airline. Maybe the seller of this future is, I don't know, Chevron. Why did they do that? Well, this airline says, you know what? I need to buy oil, right? The price of oil is one of my big expenses. And I want to somewhat lock in my prices because I don't want, what if I get to October and I need more oil and I don't have it? I need to lock in promises and I need to make sure that I have enough oil in October. And I want to make sure I'm not paying some extreme price. What if I get to October and the price has gone all the way up to 120? I'm going to kind of be ticked off that I have to pay 120. I'd much rather pay 92. Now, granted, there's risk to the airline. What if the price plummets to 70 and I'm still obligated to pay 92? Well, that's the price I pay for locking in that future contract, right? I have risk, I have reward to the price moving, whether it worked out or not. But the airline might say, I'm fine with that because I can make money with oil at 92. I can make money and I don't want all that added risk that the price is going to go crazy. So there are buyers for reasons that they might use that oil in the future, right? Chevron on the other side is producing all of this oil and pulling it out of the ground, and they also have risk and reward to price movements. And for Chevron, prices going up would be good, but prices going down would be bad. And Chevron might want to hedge some of that and say, well, we're pulling all this oil out of the ground. Let's lock in some future prices. I'm pulling it out. It cost me $60 a barrel to pull it out of the ground. I'll go ahead and lock in the ability to sell at 92, right? I can make money at that. And so do they have risk? Well, if the price goes up, they're still obligated to sell that barrel of oil for 92 bucks. That was the promise that they made, right? But if the market goes down on the flip side, they also, have risk in that, or reward in that, if the price of oil goes down to 70, but they locked in the ability to sell at 92, that's better for them, right? So it's a risk to reward thing. They have made a promise to sell at 92. That's going to be good if prices go down. That's going to be bad if prices go up. But they might look at it as good just because, regardless of where oil goes, they can make money in either of those circumstances. They can make money if prices go up, and they can make money if prices go down. So they kind of don't care which way it goes to a certain extent. Now, granted, they don't do this on every piece of production, right? So Chevron would still be rooting for prices to go up. The airline would still be rooting for prices to go down, because even though they have this amount hedged and protected in the future, they know they're going to have to keep doing more and more of it in the future as well. So the airline says it's just better for us if prices stay down. And Chevron knows it's going to be better for them over time if prices go up. Now, who else might be trading these futures? Someone we call speculators. And that's basically you and me. These are people that might trade the futures, but not because we have anything to do with oil as a business, right? I am not an airline. I am not an oil company. If I'm trading oil futures, I'm doing it for purposes that are just speculative. Now, as a speculative trader, I'm going to have enormous amounts of risk and reward because I'm not using the oil. I'm just speculating on its price. I can go long the oil future, or I can go short the oil future at 92. But I'm going to have enormous risk and reward from that point on as the price moves. And it can be fairly extreme. I mean, light sweet crude, if we look at the CL contract, it's worth 10 bucks per 1 penny. It gets really quite pricey and quite expensive, where if the oil future moves $1, at 10 bucks per penny, if you kind of think of it in terms of its value, 100 pennies at 10 bucks each is $1,000, meaning that if I buy oil at 92 and it goes to 93, I'm up $1,000. But if it goes down to 91, I'm down 1,000, right? And so you can be up or down pretty big. Now, there's different sized contracts and so forth. Not all futures. You have to look at what their values are, how much a tick is worth, and so forth. But basically, it's a higher risk, higher reward game. And if you're speculating, then obviously you're not going to accept delivery of oil. So you have an expiration date. You have to be out of the contract before that to avoid deliveries and so forth. In fact, you'll probably be forced out by your brokerage. Your brokerage won't, you'd have to fill out special paperwork and whatnot to actually accept delivery and go to Chicago or go to Oklahoma or go to these places where you'd actually accept your delivery. You're not going to have a barrel of oil shipped to your front door or something like that. So it will probably be that at your brokerage, they would actually force you out of the contract at a date before this expiration anyway, tends to be how it happens. So the way we would control that, of course, we would use stop losses. If we were going to speculate on the price, we would put in an automatic stop loss to kick us out if we were wrong about the trade. Now, two promises, and you can trade these. Let's look at the oil market specifically and futures in general. Let me pull this up. Let's pull up an Interactive Brokers account. You'd have to be set up to trade futures and whatnot, but let me just show you some examples. So if I put in CL, it's not Colgate Palmolive, that's the stock. If I come down here, light sweet crude oil on the NYMEX. There's different exchanges. There's the CME, the Chicago Mercantile Exchange, and so on. But let's trade this one. We'll click on the futures, and you can see that there's an October future, there's a November. Let's put in a few of those, in fact. Let me just show you there's different prices. Okay, so what are we looking at here? Well, this is light sweet crude. It's a little different product than Brent crude. What is Brent crude? Brent crude is it's a dirtier oil. It needs more cleaning, more refining. Light sweet crude is kind of what it suggests. It's kind of a cleaner oil. It doesn't need to be as refined and whatnot. So there's just different types of oil out there. Now, this is the price for a barrel of oil, but you'll notice that the prices are different. A barrel of oil in October will trade at a different value than a barrel of oil in November, which will trade at a different value than a barrel of oil in December. That difference in pricing is due to a few different factors, supply and demand most specifically, the market's positioning, how it thinks it should be priced and whatnot. And so this is natural pricing based on supply and demand. As supply and demand push these prices, the prices will move. You'll notice that they don't all move equal. This contract is down 1.4% today. December is only down 1.2. So they're moving somewhat in lockstep. I mean, you can kind of see that they're moving together. They're certainly correlated. It would be highly irregular to see, October down 10% and December up 5%, but it could happen. It's actually possible for those things to happen. And this pricing is called contango or backwardation. It's one of the two. And those names, contango and backwardation, speak to how these contracts are priced compared to each other. Now, these contracts, you can see that they're very liquid. I mean, the prices are close together. There's constant transactions going through. You can see the last here, it'll constantly be moving. These are the last transactions that took place. Some contract just traded at 87.94. Now another one just traded at 87.96. Up here, one traded at 88.45. This one traded at 87.97. You'll see transactions going through over and over again. This is the last trade that took place. There's more liquidity, generally speaking, in the front month contract. So right now, the October would be trading more contracts generally than would November, and November would be trading more contracts than would something, say, December. That's the general feel of it. It kind of works the same way in the options market, right? The two contracts that trade the most amount are the front month. So the 1 month contract in options will trade the most, and then the second most will be the 2-month option, and so forth. The closer you are to expiration, the more contracts tend to trade. And that's true of futures as well. So Most people are kind of trading the October, and then as October approaches expiration, they'll rotate out and trade the November. Now, what is contango and backwardation? Well, first of all, contango is normal pricing. It's kind of your standard, what you'll usually see. And so what you usually see in prices is what? Well, if I were to ask you, let's just think about it this way. Do you think that a can of Coca-Cola is going to be more expensive in the future or less expensive? Do you think the prices are going to go down over time or up over time? What would your answer be? What would logic tell you? Look at your history. Look at your life. Has a can of Coca-Cola gotten less expensive over time or more expensive? So prices tend to go up over time, right? If we were looking at future contracts for Coca-Cola or a house or a stock or a barrel of oil or a bushel of corn, we're going to bet that the price is going to get more expensive longer term. That's normal. That's what we call contango pricing. So what we would anticipate to see is that October might trade at $88 a barrel. Then we would expect November to maybe be trading at 89 a barrel and December to be trading at 90 a barrel, right? Because we would expect, kind of like a can of Coca-Cola, um, you know, our price is going to go up or down at the store. Well, they're going to raise prices. So, maybe a can of Coca-Cola is $2 in October. If it's going to do anything in change in November, it's probably going to go to $2.02, $2.05 or something. And then if they do go change the price in December, it's probably going to 210. It's probably not going down. They don't tend to mark prices down as much as they tend to mark prices up over time. So we would expect that oil would get more expensive over time. That's normal pricing. Well, backwardation is just basically what the word suggests. It's backwards. It's abnormal, right? Is basically the takeaway. So what happens in backwardation? Well, in backwardation, something is off. And look at what's happening here. Look at the oil market right now. October is at 88. November is at 87. And let's put in, 88.20, 87.70, 87.10. That's basically the current pricing for light sweet crude, a barrel of oil, in October, November, and December. It's backwards to normal. Here, prices are getting less expensive out in the future, and that's abnormal. So what's happening in that market? Well, usually backwardation speaks to that something's off, right? Something is out of the ordinary. And there can be a lot of different reasons for that, and we'd really have to dig in and kind of look at why it's priced that way and so forth. But usually, generally speaking, it's a supply and demand situation, and there can be some sort of explanation for it or expectation that maybe, they're going to supply more, but there's just not enough right now, or there's so much demand right now, but it's expected to drop in the future, or whatever it may be, that you could put some sort of explanation. But let me give you kind of a typical explanation for backwardation. There's not enough supply in the short term, but it can be made up for over time. Let's say, a good example of this happened a few years back. Do you remember, and this has been, I guess, quite a few, I don't even remember how long ago it was, but do you remember that there was basically a huge explosion, terrorist activity, where a bunch of oil supply was blown up, millions and millions of barrels over in the Middle East. And this comes back to, Iran and all these different countries. But anyway, I think they basically identified that it was Iran and put more sanctions and so forth that did it. But that disrupted the oil market. Why? Because if you had millions of barrels of oil that were expected to come into the market and be delivered to various countries and economies that needed it, and all of that oil was ruined, exploded and wasted, we have less supply than we had planned for. So what happened to the front month contract? The price went up dramatically. The price of the front month shot up because people said, uh-oh, we've got a supply problem. We've got X amount of oil that's needed in the market, and we just simply do not have enough now. The market has changed. There's not enough supply. Why didn't the later contracts move up that much? Because everyone said, well, this is a short-term problem. We can make up for it. We can bring more oil onto the market in the next few months. We can ramp it up in the US and Canada and the Middle East. We can make up for that, right? But it takes time. You can't just, it's not like flipping on the lights, right? You can't just wish your way into millions more barrels of oil. It takes time. You can increase production and do some things where you can make up for it out here, but you can't do anything here to make up for it, So all of a sudden, you get a backwardation. You get that there's not enough supply in the short term. The market might be anticipating. Why is it backwardated right now? I think the market's anticipating economic softness. When the economy slows, the demand for oil goes down. Part of the explanation for backwardation right now is maybe an expectation for some economic softness, right? And some weakening outlook and demand for oil and such. But something is off. That's the important point, is when you get into backwardation, something is abnormal, and that tends to be, somewhat of a risk to the markets. And this can happen in any commodity. This can happen in a variety of different assets, but it's something that's a little bit off in terms of the supply and demand. So that's contango and backwardation. And that's the kind of the pricing structure there. When oil went negative, what happened there? Well, basically demand went away, and they were still supplying massive amounts. And what happened is, over in the Middle East, they kept supplying. I think they did it on purpose. The big countries over in the Middle East kept putting more and more oil into the market. They didn't cut back on production. And so you had all of this oil, and oil will spoil, right? It has to be used. It can't just sit dormant for decades or something. At some point it'll spoil and be no good. Now you can store it for a little while, but you can't store it endlessly. And so they just kept pumping more oil and supplying it to the markets. And part of that was strategic on their part. They wanted to basically hurt different companies and competitors and economies and so forth, and really drive some competition out of business. And they probably did that. So oil just kept collapsing. And at a certain point, it went negative, which people thought there's no way that oil will go negative. Think of how weird that is in a futures price when oil goes negative. It means that, it went to negative $30 or more a barrel. What does that mean? That means that somebody was paying someone else to take their oil away from them. So, literally, somebody was paying $30 a barrel to say, you take the oil so I don't have to. And part of that was speculators, right? Speculators that didn't have stop losses, well, they were getting clobbered because essentially they couldn't accept delivery of the oil. And what were they going to do with the oil if they did accept delivery? So they just had to be wiped out, and they had to pay someone else to basically take the oil from them. Now, all that, what some big brokerages, Goldman Sachs, Morgan Stanley, some places will do is they'll actually try to take advantage of different things. If there's a big contango pricing differential, then they will rent out these big tankers and float it out in the ocean, out in the Gulf of Mexico and so on. So they'll take this big, tanker, and they'll put all these barrels of oil on there. Okay, thousands of them. And if there's a huge contango, which sometimes there is, what they will do is they'll basically say, well, I can buy oil at 88 and lock in a contract to sell it at 90, and I'll make $2. Do you see that? I promise to sell it in December. I buy it in October. I put it on this big tanker and I float it out here at 88 cost. And then when December rolls around, I deliver all this oil. I won't draw them all out, but I go and deliver all this, and it hasn't spoiled or anything. And so I'm making $2 per barrel. And if my contract, to rent and to float this out here is pretty small, well, I make a ton of money, And so they'll do things like that. There's all sorts of ways that people will try to exploit these pricing differentials. This is something that could have been done when oil went negative. If you said, well, it's negative now, but think of how good it would have been if you could have got paid $30 a barrel to buy it and you could float it out there. Imagine you had access to something, and not only did you not have to pay for your oil, somebody would pay you $30 per barrel for you to float it. So they're basically paying your expense for that rig and then some. And then if you could lock in a future contract a few months later to maybe sell the oil for 40, I mean, it would have been a cash windfall. The problem is that so many of these companies were already renting. There were no more tankers. There were no more space to basically, all of this had been utilized. There just wasn't access to that. So it ran out. I mean, there was so much supply that it basically overloaded any of these, arbitrage opportunities. This is called an arbitrage, where you're trying to take advantage of these price discrepancies. And it would have been a huge opportunity in March of 2020 when oil prices went negative. You could have pulled off an incredible arbitrage, but the damnable misery of that was all these tankers had already been filled up, and there just wasn't the ability to do that. So we'll leave it there. Thanks everyone for joining us. A great discussion on contango, backwardation, normal, abnormal pricing, and how to handle that. Have a great rest of your day, and we will see you next time. Goodbye, everyone.